start by understanding what Section 39 of the Income Tax Act 1967 is all about. This section lists out expenses that are strictly not deductible when calculating your adjusted income for tax purposes. Even if these expenses are related to your business, you can't use them to reduce your taxable income. The main purpose here is to prevent any abuse of tax deductions and to ensure fairness and compliance with tax policy. So if you're running a business, knowing what's not allowed is just as important as knowing what is. How does Section 39 exist? The answer is simple: to keep the tax system fair and prevent people from claiming deductions they shouldn't. By clearly stating which expenses are non-deductible, the law ensures everyone plays by the same rules. This helps maintain the integrity of the tax system and makes sure that only genuine business expenses are deducted. It's all about compliance and fairness, so businesses can't just write off personal or unrelated costs. Normally, to be deductible, an expense must be revenue in nature and incurred wholly and exclusively in producing income. This is the general rule under Section 33. However, Section 39 overrides this by specifying certain expenses that are never allowable, even if they seem to relate to business operations. This means that just because an expense is connected to your business, it doesn't automatically qualify for deduction. One major category of prohibited expenses is private or domestic expenses. These are personal or family costs that have nothing to do with your business. Think of personal groceries, household utilities, or private travel. Even if you're a business owner, you can't claim these as business expenses. The law draws a clear line between personal and business spending to avoid misuse. Capital expenditure refers to money spent on acquiring capital assets like buildings, machinery, or vehicles. These are not deductible as expenses under Section 39. Instead, you can claim capital allowances under Schedule 3. This distinction ensures that only ongoing business costs, not investments in assets, are deducted from your taxable income. Counting depreciation is another expense that cannot be claimed for tax purposes. While businesses may record depreciation in their books, only capital allowances are allowed for tax deduction. This prevents double dipping and ensures consistency in how asset costs are handled for tax purposes. Any income tax paid, whether to Malaysian or foreign authorities, cannot be deducted from your taxable income. This means you can't reduce your tax bill by claiming the tax you've already paid as an expense. The law is clear: tax payments are not business expenses. Fines or penalties imposed under any law, such as traffic fines or environmental fines, are not deductible. The rationale is simple: the tax system shouldn't subsidize unlawful behavior. If your business incurs a fine, you'll have to bear the full cost without any tax relief. General provisions, such as those for bad debts or contingency reserves, are not deductible unless the bad debts are actually written off. This means you can't claim a deduction just for setting aside money for possible future losses. Only actual, realized losses count. If you incur costs to earn income that is exempt under the law, such as certain dividends, those expenses are not deductible. The logic is straightforward: if the income isn't taxed, the related expenses shouldn't reduce your taxable income either. Charitable contributions are only deductible if they are approved under Section 44(6) or gazetted by the authorities. Donations to non-approved charities, no matter how noble, are not deductible. Always check the approval status before claiming any donation as an expense. Entertainment expenses that are not related to business purposes, such as entertaining family members, are not deductible. The law is strict about separating personal enjoyment from business activities. Only entertainment that directly serves a business purpose can be considered. Any expenses related to illegal or prohibited business activities are strictly non-deductible. This includes costs incurred in running or supporting activities that are against the law. The tax system does not support or subsidize unlawful enterprises in any way. Section 39 makes a clear distinction between capital and revenue expenses. Capital expenditures like buying assets are not deductible as expenses. Instead, you use capital allowances to claim these costs over time. This ensures that only ongoing business costs, not investments, reduce your taxable income. It's important to remember that any tax paid, whether local or foreign, cannot be used to reduce your taxable income. This rule is absolute and applies to all businesses. The idea is to prevent a circular reduction in tax liability. Section 39 disallows accruals, provisions, or reserves that are not actual outflows. This means you can't claim a deduction for money you haven't actually spent. Only real, incurred expenses count for tax deduction purposes. Private or personal expenses are always non-deductible, even if they are partly related to business. The law is very clear on this point: if an expense has any personal element, it cannot be claimed as a business deduction. Expenses incurred to earn income that is exempt under the law, such as certain dividends, cannot be deducted. This ensures that only expenses related to taxable income are considered for deduction, maintaining the integrity of the tax system. Let's look at some practical examples. Payment of corporate income tax, fines for environmental violations, personal holidays for staff, and the purchase of office buildings are all non-allowable expenses under Section 39. Even general provisions for doubtful debts and donations to non-approved charities are excluded. Expenses to earn exempt dividends also fall into this category. Consider ABC SDN BHD for the year 2024. Salaries and wages as well as EPF contributions are allowable expenses. However, the purchase of an office building, traffic fines, and staff team outings for personal reasons are not deductible. Only donations to approved charities are allowed. This example shows how careful categorization is crucial for tax compliance. Section 39 overrides general deduction rules. Non-allowable expenses cannot reduce taxable income even if they seem business-related. Capital items, tax payments, fines, personal expenses, and expenses relating to exempt income are consistently non-deductible. Proper categorization of expenses is crucial for tax compliance and audit readiness. Here's a quick summary. Salaries, rent, and EPF contributions are generally allowable. Fines, tax paid, personal travel, capital expenditure, and non-approved donations are not. Always refer to the relevant sections, Section 33 for allowable expenses, Section 39 for non-allowable ones, and Schedule 3 for capital allowances. Section 39 ensures that only genuine revenue expenses incurred wholly and exclusively for business purposes are deductible. It prevents abuse, maintains the integrity of taxable income, and complements Sections 33 and 34 by clearly defining what cannot be deducted. Remember the mnemonic: PCFTED, private, capital, fines, tax, exempt income, donations, non-approved.